All right, let's dive right into this explainer. We're unpacking a really fascinating strategy today proposed by Nationwide Real Estate Acquisitions, LLC. If you've ever, dipped your toes into the real estate market, you already know selling a property can be an absolute headache. So today we're decoding a highly structured approach called temporary seller financing. It's specifically aimed at solving some of those massive bottlenecks for the for sale by owner crowd.
Now here's a question that constantly plagues the market. Why does so many for sale by owner properties just sit there? I mean, imagine the sheer frustration of listing a free and clear property on sites like Zillow or Redfin, and then you just watch it languish for months. No viable offers. You prep the house, take the photos, put it up, and then you're just met with absolute crickets. To fix this super stressful situation, we kind of need to understand why it's happening in the first place.
Which brings us to Section 1, the FSBO dilemma, the struggles of selling.
So the core issue really boils down to the traditional financing hurdle. Right now, a massive number of for sale by owner properties sit totally stagnant because the seller is just stuck playing a waiting game. They're basically crossing their fingers, hoping for a unicorn buyer to walk through the door, somebody with pristine credit, immense cash reserves, and the ability to effortlessly lock down a bank loan. And let's be real, in today's climate, that buyer is a pretty rare find.
The real problem is that a massive pool of highly motivated buyers is completely sidelined by traditional banks. These institutions are out here requiring hefty 20 to 40% down payments before they'll even consider looking at a mortgage application. Think about that. That huge slice of upfront cash completely shuts great buyers out of the market, which leaves sellers with a rapidly shrinking pool of prospects.
Moving on to Section 2, the seller financing myth, busting stereotypes.
To bypass this whole financing hurdle, our source suggests an alternative. But there's a catch. As they put it, the old way of doing seller financing has gone the way of the dinosaur. When independent sellers hear the phrase seller financing, they instantly picture an absolute nightmare. They think they're going to have to act like a bank, make super awkward phone calls, and chase down monthly checks from a buyer who's dodging them. I mean, it literally sounds like taking on a highly stressful second job, right?
But we really have to separate the myth from the reality here. The dinosaur days of tracking mounds of paperwork, they're dead. A modern transaction utilizes a third-party note servicing company, and here is the real kicker. It is paid for entirely by the home buyer. Yep, they handle the admin, they collect the money, and they manage all the paperwork. So you get all the benefits of being the bank without ever having to actually act like one.
Okay, Section 3, a temporary financing solution. Quick, profitable sales.
45 days. According to Nationwide Real Estate Acquisitions, LLC, by using temporary seller financing, a free and clear property can be sold for its full asking price with zero upfront fees in 45 days or less. Crazy, right? By opening the door to those buyers who were sidelined by bank requirements, the seller effectively creates their own demand. It spreads like wildfire and dramatically accelerates the timeline of the whole sale.
And even more surprisingly, this isn't just about speed, it is really about capital access. At the close of escrow, the seller actually receives a huge lump sum, 30 to 50% of their asking price in pure upfront cash. It's only the remaining balance that actually gets financed over the short term. So getting this massive, immediate cash injection completely flips the script on what we think of as typical financing arrangements.
Let's dig into Section 4, mechanics of the deal, structuring the trade.
So you might be wondering, how exactly is the seller's equity protected? Well, it all comes down to some really strict operational requirements placed on the buyer. They definitely don't get a free ride here. Like we mentioned earlier, they pay for the third-party administrators. But crucially, and this is a real game changer, they are strictly required to purchase and maintain mortgage protection insurance. It's not optional. It is baked right into the very structure of the deal. And the result of that strict mandate? Fully insured monthly payments. Because the buyer absolutely must maintain that protection, the seller is completely insulated from risk. Literally, you never have to worry about a buyer missing a payment because of a job loss, an injury, or really any other reason. Every single transaction is fully insured by a third party. Talk about peace of mind.
Finally, to cap off the mechanics, we have to talk about the timeline, 12 years. The source explicitly states that sellers will never carry a note for 15, 20, or 30 years like a traditional mortgage. Actually, scratch that, it's a maximum of 12 years. All of these transactions are structured to conclude with a lump sum balloon payment in 12 years or less, hence the term temporary seller financing. You get cash up front, insured monthly payments, and a final balloon payment to completely close out the whole shebang.
Which brings us to Section 5, the fine print, scope, and limitations.
Now, before anyone jumps into this, let's look at the scope and the necessary disclaimers. First off, the scale here is massive. We're talking properties ranging from $60,000 all the way up to an incredible $150 million. But note the professional status here. Kevin Young Sr. is acting strictly as a consultant. He's not a real estate agent, a mortgage broker, a lawyer, or an accountant. He doesn't render legal or tax advice. So anyone utilizing these strategies would for sure need their own professionals to review contracts and fully understand the tax implications of those insured payments and lump sums.
So we've seen how this strategy bypasses the steep down payment hurdles of traditional banks. And we've seen how third-party servicing and mandatory insurance make it totally hands-off and secure for the seller. But as these alternative financing structures become more streamlined, insured, and just generally accessible, it leaves us with one massive question. Will third-party managed seller financing make traditional bank mortgages a thing of the past for independent sellers? How will major retail banks be forced to adapt in the coming years? It's definitely something to think about.